How to invest in ASX stocks, especially if you're a beginner. What is up everyone, it's David here. Now, once a month, I do hangout sessions with people in my Discord server and they can ask me whatever the heck they want. Whether if it's stocks, my experience as a head of growth for a VC-funded startup, I'm an open book. And an interesting question came up the other day. How come there isn't more people
gently smashing that like button on David's videos?
Just kidding, that's the question I ask myself when I watch my own videos. Okay, in all seriousness, a couple people in Discord and also a couple of my friends have asked me, how can I get started investing in shares in Australia? So instead of answering everyone's emails and also DMs, I decided to just create a step-by-step guide video on how to invest in ASX stocks with as little jargon as possible. And of course, I'll finish off this video with a quick update on my portfolio and also the stock I bought over the week. As usual, if you just want to support me so that I can keep making videos for you, just make sure you gently smash that like button right there. And I might just make one of your future wishes come true. Now, without further ado, let's go. Now, to make life really easy for you, I've summarized the process of investing in ASX stocks in 3 simple steps. The first step is preparation. Second is choosing a path. And third is building a habit loop so that you can keep investing. Don't worry, I'll explain all of them in detail in just a second. And yes, I'll also be covering brokerage platforms as well, so that after this video, you should have everything you need to get started investing in shares in Australia. Now, under each of the steps, there are some key questions you need to answer. And for simplicity's sake, I've created a checklist for you after each step, so that if you want, you can go through and check them off as you watch this video. So let's talk about preparation first. The first question I asked myself when I started investing is, do I have any high interest debt? For example, credit card debt that's anywhere between 15 to 20% really should be paid down before you consider investing in stocks. Because at the end of the day, any high interest debt will just eat away all your stock returns. Number 2, do I have an emergency fund? That could be $1,000 or $2,000 just set aside for rainy days. I'll explain why that is important in just a second as well. Third, have you set aside a set amount every single month to invest? That's non-negotiable and you'll always invest that amount. And the most important question of them all is whether you need that money in the next 6 to 12 months. And if that answer is yes, do not touch that money. Because if you need that money, you'll be constantly checking your phone every 15 minutes to see how much money you made or how much money you've lost. And if the share price goes up and down like a roller coaster, you are gonna get very anxious. Because the feeling of losing $1 will always hurt you more than gaining $1. That is what we call loss aversion. Because if you need that money, you're gonna amplify the feeling of loss aversion. Ultimately, that will cause you to make some very emotional decisions that will hurt your effort in building wealth in the future. This is why you also want an emergency fund. Because if you need emergency cash for whatever reason, the last thing you wanna do is sell down your stock to fund that purchase. And by doing that, you might just miss out on the most important returns in your investing career. According to JP Morgan Asset Management, if you invested $10,000 in S&P 500 and missed out on 10 of its best days, your return over that period will be cut by more than half. So in the preparation phase, our objective is just to minimize our exposure to emotional decision making and stay invested over the long term. Don't get me wrong, I'm not saying never sell. I'm just saying that if you had to sell down your stock in order to buy a Gucci bag, that's probably not a very good idea. So using myself as an example, I don't have any high interest rate debt when I started investing. I always pay down my credit card debt at the end of the month, so there's no interest charges. I have an emergency fund of approximately $2,000, and that's just to give myself a bit of breathing room just in case I need it in the future. I set aside 40% of my paycheck every single month. I used to set aside 60%. I'm just trying to add a little bit more to my emergency fund at the moment because who knows what's gonna happen in the future. I just wanna give myself a bit more of a breathing room if something were to happen. And I definitely don't need that money in the next 6 to 12 months. So what you see on the screen right now is a checklist for this step. Feel free to pause this video and write them down. That helps you, or you can just come back another time and revisit this video. Now that we are financially and mentally prepared, the next step is choosing a path to start your investing journey. First, you need to decide how much time you're willing to put in to research what you want to invest in. If you want to spend less than an hour each week on research, going with a diversified pre-built portfolio of stocks like ETFs or LICs is a good way to go about investing in ASX stocks. And this is also known as passive investing. On the other hand, if you don't mind nerding out and putting in a lot more time to understand the underlying business, then choosing your stocks are absolutely fine too. And this is also known as active investing. Now, regardless of what you choose, here are some very important notes. If you choose to go with a pre-built portfolio like ETFs or LICs, the most returns you can get is probably the market returns, which is approximately 8 to 9% depending on which period you look at. Now, if you go with choosing your own stock, sky's the limit when it comes to returns, but your losses are capped to however much you decide to put in the market. Personally, I'm in my late 20s and I'm a get rich slow kind of guy. There's nothing more attractive to me than getting rich slowly with as little drama as possible. So I went down the passive investing route when I first started investing, putting majority of my money in ETFs that tracks the Australian or US market and in listed investment companies. I actually recommend a more passive approach to investing if you're just starting out. You want to get comfortable with the markets first before you learn how to choose your own stocks. If you want to go down the passive investing route, I recommend looking at ETFs or LICs with really low management fees and a well-diversified portfolio across multiple industries. And low management fees as in lower than 0.15% if possible. To help you get started, here are a couple ETFs and LICs that's worth researching. VAS is a classic Vanguard exchange traded fund that tracks the top 300 companies in Australia, and their management fees are 0.10%, which is quite low. VTS is another ETF that tracks the entire US market, and their management fees per year is 0.03%, which is also really, really low. AFIC is the largest listed investment company in Australia, and their yearly management fees are 0.14%, also really low. And Argo is the second largest listed investment company with a yearly management fee of 0.15%. I own Argo and VTS in my portfolio. If you want to know exactly why I've chosen each of the stocks in my portfolio, I've dedicated a full video on that. And if ETFs and LICs are also really confusing to you, I've dedicated a full video on that as well. Now, both of those links are in the description box below, and I've also created a full playlist for you if you want to watch those videos in chronological order to get a better understanding. Needless to say, make sure you do your own research because this video is not intended to be financial advice, just purely for entertainment purposes. Now, once you've chosen a path, you need to decide the kind of investor you are. Do you prefer a balance of consistent dividend checks with a bit of share price growth? Or do you prefer stocks with rocket type share price growth? Because deciding what you value will keep you grounded when shiny stocks fly past your screen. For me, I see investing as a habit, and dividends are the best way to keep myself motivated to keep investing in the long term. So yeah, I'm a long-term, get rich slow, boring dividend growth investor. Don't worry, I'll talk about brokerage platforms in just a second. And I've purposely left out the concept of time horizons because that involved me to talk about multiple asset classes. I'll save that for another video. Here's a checklist on the screen right now for this step. Last step. Let's tie everything together. I view investing as a habit, and that needs to be done whether times are good or bad. And that consistency is the key to financial independence, where you're no longer dependent on anyone for a paycheck. That, to me, is incredibly liberating. But sometimes things happen and it's out of our control. So let's talk about what we can control so that we can stick to the habit. In every habit, there is a cue, routine, and a reward. One of the biggest reasons why I chose to be a boring dividend investor over the long term is because that cold hard dividend check gives my brain such a massive dopamine rush. It really keeps me motivated to invest over the long term. This is another reason why you want to decide the kind of investor you are so that you know what motivates you. Because that's the puzzle piece for the reward section for the habit loop. When it comes to the queue, there's a certain amount in my paycheck that's automatically routed away to my brokerage account as soon as I receive the paycheck. Same time, same amount every single month. And it's important to me that I don't see the amount in my bank account because that will really minimize my level of unexpected spending. You can set rules in your bank account to automatically wire money out in a specific time and a specific amount. Feel free to try for yourself for a couple months and let me know what you think. And finally, the routine part of the habit loop, which is kind of the fun part because you get to purchase the stocks that you want on a brokerage platform. On that note, I use CMC Markets to do all my Australian investing and stake for all of my US investing. Both of those platforms, you own the shares outright, and the brokerage fees are really affordable. CMC Markets, I pay $9.50 a trade, and for stake, I'm only paying 70 cents every $100 as a foreign exchange fee. Of course, I've heard great things about self-wealth, and I am experimenting with the platform at the moment. So hopefully in the next couple months, I get to share my feedback on what I think of self-wealth. And if you still need more information on the brokerage platforms, I've created a full video on that as well. So I'll put it in the description box in the playlist as well. Here's a checklist on the screen for this step. Let's wrap up the video with a portfolio update and some market news. Okay, so let's start off with the Australian side of my portfolio. So over the last week, I've added another $2,100 into Argo investments. And if you've been following me, then you know that I've admitted to my mistake multiple times that I've over allocated into WAM research. It wasn't intended, it just, I started with 10K and then I reinvest all my dividends. Next thing I know, it's 15K and it just snowballed to 22K. So now I'm just catching up to basically allocate a little bit more capital towards Argo so that I get more exposure in the blue chip ASX dividend growth stocks. So nothing fancy, nothing too out of the ordinary. Things are still humming along. And as many of you have already noticed, ASX have pulled back by a little bit because of, the updated situation in the pandemic. But similar to what I mentioned last week, these things happen, they come and they go and people always panic. So this is one of the main reasons why I invest long-term. And I try not to look at these prices on a day-to-day basis. Well, also because I have better things to do, to be honest. So let's take a look at my US dividend growth investing portfolio. So this is my US dividend growth investing portfolio and this is in US dollars. The gains are still the usual suspects. The tech firms like Apple, Dropbox, Microsoft have benefited from this. Last week, I actually made a mistake to call Prologis as a tech company. They're not. These two are actually real estate investment trusts. And Prologis is more focused around the logistics area and Realty Income is more in commercial real estate. Now, don't confuse commercial real estate being office real estate because majority of their assets are actually in malls and majority of the people they rent to is actually pharmacies. So these are considered to be essential companies, if you will. And thankfully, they are still collecting rent and they do have gyms and they do have movie theaters as well, which is taking a bit of a hit. But overall, they've been doing really well. And this is a monthly stock for me. And I'm really happy with my portfolio allocation at the moment. I haven't added anything new in the stake portfolio because I'm waiting for my first YouTube paycheck to add to my US dividend growth investing portfolio. Now, on that note, Dropbox and GoPro, they're not dividend stocks. Same with, actually Nike is still considered to be a dividend stock, but Dropbox, GoPro, and Nike are purely free stocks that are given to me whenever any of you do decide to try stake out for yourself. I'm not sponsored by Stake. I just really like Stake because it's affordable to trade US stocks with it and it's really easy. So if you want to try Stake for yourself, I'll leave a link in the description box below. Again, I'm not sponsored. I just want to quickly show you this graph because I use this as a way to keep myself motivated. Now the red line is the actual dividends I got paid that month and the blue bars are essentially the amount of dividends I expect in that month. Now, how I get my expected monthly dividends is ultimately just taking the entire annual dividends that I will get paid, dividing it by 12. So this is something that I just artificially created to keep myself motivated. And as my portfolio grow, you should really see my expected monthly dividends go up as well. And hopefully, as I take you on this journey with me over the next couple of years, we'll get to 1,000, 2,000. And if it's a 2,000 a month income, that's pretty freaking incredible in my opinion. Just a bit of market news before we wrap up this video. On the 19th of June 2020, AFR released a report to say that fund managers are concerned. They're concerned about the 45% rally that's experiencing in retail stocks, and they're not sure whether the consumer confidence can stay that high without job keepers. Retail companies like CityChick, JB Hi-Fi, and Kogan have experienced one of the largest growth trends over the last couple of months. JB Hi-Fi is on track to deliver its largest profit growth in years, and Kogan has reported that they're doubling sales in both April and May. For me personally, the question I like to ask is, what is the percentage of sales from these retail companies that's actually done on a buy now, pay later type services? In its simplest form, this is how a buy now, pay later type arrangement works. Consumer purchases a product from the merchant, and as soon as this transaction has finished, buy now, pay later will make a lump sum payment to the merchant.
This could be Zip or Afterpay, whatever pay companies out there. And as soon as this lump sum payment occurs, all of the credit risk that used to reside in the merchant side from the consumers will immediately get passed on to the buy now, pay later type company like Zip or Afterpay. This is one of the main reasons why I am so interested in the amount of sales that's actually done on a buy now, pay later type arrangement. Because if in September, the government decides to pull the JobKeeper payments, can the consumer still make his monthly payments back to buy now, pay later type companies? Because we have to remember, these companies aren't profitable at all. They're far from it. And if the default rate on these small loans go up, that will significantly amplify the cash burn that's going to happen in these buy now, pay later type companies. So in September and later this year, I think that's when we'll really see what will happen in this ecosystem. Whether the buy now, pay later type service is actually worth what the market is essentially saying they're worth. And I think that's really, really dependent on whether the government will pull its payments or decides to just keep the payments, and obviously that will buy time for everyone else as well.
So thank you so much for watching this video all the way to the end. It really does mean a lot to me. And if you want to support me, just make sure you gently smash that like button right there, and that will mean the world to me. So in my next video, I'll be doing part 2 of my coverage on Bob's Australia. So if that's something you're interested in, make sure you subscribe to my channel, click onto the bell so that I can let you know when that video is live. Until next time, my name is David, and Otto will always do the honors and see you very, very soon.